housing finance market, Home First Finance has seen a comfortable growth, crossing the 10,000 crore AUM milestone in FY24. Here's Harsh in conversation with MD and CEO Mr. Manoj Viswanathan to understand the segment and his future plans.
So any discussion on growth runway always starts with the most cliched statistic, which is the mortgage to GDP ratio in the country, which is currently around 11 to 12%, and which is obviously much lower than most of the countries in the world, whether you consider the developing countries or even developed countries. It's a low figure. And different states within the country itself are at different levels of mortgage to GDP penetration. So the more developed industrialized states like Tamil Nadu, Gujarat, Maharashtra, they are at higher levels compared to the country. And the less developed states are at lower levels. So which basically or clearly indicates that there is a growth runway for affordable housing or the housing industry as a whole. As per capita incomes increase, as the GDP increases, the mortgage penetration is also going to keep on increasing. And even if we look at say a moderate penetration of say 25 to 30%, which is where China would be today. It is a very long runway for the housing finance industry.
But just talk to us about competition, because we've had a slew of larger players enter mortgage in a very serious fashion. Of course, HDFC, the old guard, of course, part of that. But even some of the larger players have entered in a big fashion. Something like a Bajaj group has entered it. What's the kind of competition you're facing on ground, and what helps you differentiate with others? What gets you to do that? Because for a 30% sustainable growth, that I believe would be the first possible speed bump.
So there is obviously, because the runway is very long, and there is the housing potential is so high. There is obviously opportunity for multiple players to exist in the industry. Having said that, there is likely to be some competition, and some competition is healthy to have in the industry. There are of course players, larger players operating in a different segment. When you look at the housing finance industry as a whole, if you look at annual disbursals, they are in the region of around 10 lakh crores. But this 10 lakh crore is split across multiple segments. There is a 0 to 25 lakh segment, there is a 25 to 40 lakh segment, 40 to 75 lakh, 75 lakh plus. Each of these segments is quite large in its own right. And there are different players operating in different parts of this segment. The banks are operating in the higher ticket size segment. The housing finance companies are operating in lower ticket size. And within that, there are, specialized affordable housing finance companies like us, which are operating in the 0 to 25 or 0 to 30 lakh range. So there is enough business for everybody. It is currently a very fragmented market. So coming back to your question on, how do we, keep hitting the 30% annual growth rate? So growth for us is, one is to keep moving in tandem with the growth of the country. So country is growing at a strong clip. So making sure that, we are doing all the right things to, ensure that our growth keeps pace with that. Broadly for us, the growth will come from three vectors. So one is basically expanding the geography. So when we say expanding geography, it's not about expanding into new states. We are currently present in 13 states. So we are going to basically, expand into those 13 states. So we still have a lot more opportunity for expansion in these 13 states. So new districts, new cities, etc. And then second vector is basically a deeper penetration within existing cities. So we are already present in about 200 cities. But there may be parts of the city which are still not penetrated by us. So building our presence within the city or deepening the presence. And the third vector is, of course, market share, capturing market share. Through better service, better process, we capture share from others. So these are the three vectors for growth. And this gives us the confidence that we will be able to hit that 30% growth rate, for the for the foreseeable future.
Okay, so looking fairly comfortable. What does competition do therefore? Do you think yields will start coming off if competition pressure increases, or are you still reasonably comfortable that even with competition there existing has always been there, you will be able to sustain this kind of a yield curve of 13.5%?
So competition, within the same segment, competitors tend to act fairly rationally as far as pricing is concerned. Because, at the end of the day, ultimately everybody has to make certain margins and they have to deliver returns to the shareholders. So it's not that within the same, because within the same segment, the profitability metrics remain similar. If we are charging a certain yield, then there is a certain cost attached to it. There is a certain credit cost or losses, and then you end up making the profit. So there is it tends to be very similar for most of the players in the same segment. So within the same segment, pricing is range bound. So you will not have somebody operating at very low pricing in our segment. So in each segment, there is a certain pricing that the players are operating at. So what I'm saying is that competition tends to be rational. So ultimately, it boils down to who's delivering better service and who can extract that small premium from the customer for delivering that extra service.
I fully take your point. I fully take your point. If I were to kind of try and understand your margin trajectory, it's come off. Even though ROAs have improved and essentially the metric should be ROAs, but just to try and understand where margins are therefore going, and rate cuts should probably help margins as well, give us that perspective. But margins, where would you like to see it therefore?
So margins, we have always maintained that our business, the affordable housing business, is 5 to 5.25 margin business. Spread business, 5 to 5.25% spread business. And the margins, net interest margins will keep compressing as we keep levering the book. As we keep on loading more debt on the balance sheet, the net interest margins will compress gradually. So the metric that we should be looking at is the ROE, because even the ROAs will compress slightly as we keep on levering the book. But ROE is what we are focused on, and because that's what we are returning back to shareholders. Yeah. And that's a number that we are very focused on. We have been delivering industry-leading ROEs. So 16% plus we have crossed in the last two quarters consecutively, and we are confident that we can deliver 17 to 18% ROEs in this business at our at the kind of leverage that is allowed for our company.
But what gets you there? What gets you there? What gets you to the 17 to 18% in your view, sir?
So what gets us to 17 to 18% is we have to deliver around 3.5% ROAs.
Yes.
Right. So let us say the net interest margin is around 5%. On that we add another let's say 2 to 2.5%, which is our additional income. So income that comes from fee income, etc. So 7.5% is the total income for the business. So of which the cost to income ratio you would have seen is around 35%, 35%. Yes. So you knock off about 2.5 to 3% there. So between 4.5 to 5% is our PBT, and take away another 1% for the cost. So we are able to deliver about 3.5% ROAs. So 3.5% ROAs with about between 5 and 6 times leverage will take us to that 17 to 18% number.
So easily explained. Thank you for that. If I were to try and understand what helps Home First stand out, one of the things that helped, at least in terms of understanding what helps you stand out, is with regard to your the number of disbursals or the loan book per branch that you have versus peers. It's extremely high. Just talk to us about this. Talk to us about sustainability of this. And talk to us about growth in branches. So this number, do you expect it to come down as you grow geographically, or you expect that number to sustain?
So our aim is to, so this is part of our differentiation strategy. So differentiation starts with more empowered, a leaner team, but more empowered team, a more well-trained team. So which is delivering a higher productivity. I mean, ultimately, that is the crux of the strategy. So higher productivity that is delivered because because of our use of technology, because of our strong processes, we are able to get the team to deliver a higher productivity. And that in turn, in the metric, it translates to basically higher disbursal per employee. So in our case, it's about 3.5 crores per year is the disbursal per employee, which is again higher than most of the competitors. And like you mentioned, disbursal per branch and the AUM per branch number is also industry-leading figures. So our aim will be to keep on building that margin, building that gap between us and competitors. So higher disbursal per employee, higher disbursal per branch, disbursal and higher AUM per branch. We still have a long way to go there. Currently we are at about give or take about 670 crores of AUM per branch. That number, I mean, we have some branches which are even at 200 crores AUM. So there is still, good headroom there for us to improve. And we'll keep on building on that.
Understood. Now, I want to couple the last two questions along with this one. So, ROAs plus the strategy with regard to branch, plus your centralized strategy with regard to approving of loans, which is done centralized. Please correct me if I'm wrong. How does that tie in with credit costs? So, if you can give us the full picture with the credit cost expectation, how it's played out, the FY22 number was slightly elevated, and how it ties up with your ROA anticipation and ROE of 17%.
Right. So credit cost, I mean, in our ROA calculation of 3.5%, we spoke about 30 to 40 basis points credit cost. So from the PBT of 4%, there is another 30 to 40 basis points that needs to be taken off, which leads to the 3.5% ROA.
But how do you manage it, Mr. Viswanathan, with this whole, with the way in which you do your business, which is branches are smaller branches, higher AUM per branch, plus centralized disbursements or centralized approvals for disbursements. So how do you manage that 30 to 40 bips and grow at 30% and kind of tie it all in?
Yes, since the time we started the business, our ideology has been to convert. I mean, this business was always seen as a touch and feel business. Where there is a local understanding of the customers required to assess the income, assess the business, etc. So our ideology has been to see how we can make this scalable, because if it is going to be very localized, then it will be difficult to scale. So we have tried to bring in that scalability angle through, capturing more data from day one, so that, over a period of time we can analyze it. And also, trying to make this whole assessment process more objective, and which is why our, push towards a centralized underwriting. Our whole, our strategy has actually been, you can say, boosted or supported by the entire Aadhaar stack. Because today, we can actually get digital imprints on customers sitting in a central office, which helps us to triangulate whatever information and data that we are capturing at a local level. So the idea is to capture certain things locally, which gives us that granular feeling of the feeling or understanding of the customer, and triangulate it centrally using digital imprints and data that is available centrally. So that makes the whole process more accurate and more consistent and more scalable. Because it is, if we have a small central team which is doing the underwriting, which is able to do the load balancing, which is able to give consistent turnarounds across the country. It also makes the business more scalable, because if you want to launch new markets, you don't have to worry about, underwriting. The underwriting is done centrally.
Right, with that, completely out of time on this edition of the Smith Show. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned, more action on the other side.